Now we move into the nitty gritty of understanding how to apply options into the various types of trades. So in the previous module on technical analysis, you learned about all the different types of trading styles, and now it's time to put the part where you learn the different types of trades together with the choices of options that you have to make with different trades. So for example, with scalp trading, there are a couple of pointers that I can definitely give you to shortcut your learning process. Many of you might be, running around in circles trying to figure out what is the right strike or the right expiry to pick. And here's a simplified method to pick the right options all the time. Okay. Now, obviously, there are some caveats here, which are in certain cases where volatility is extremely high, you have to be careful. You also have to look out for things like open interest and volume that is too high, because those are more susceptible to be weaponized and used against you in a liquidity event. So let's talk about the things that can go wrong later, but let's talk about all the things that you should first make your bread and butter, because scalp trading should be a bread butter exercise for most traders. So for scalp trading, we most of the time are assuming that the time frame will pretty much range from seconds to minutes in a trade. Okay, you're really capitalizing on a quick volatility event. So high volume, something that breaks a support or a resistance area or a zone, and it needs to happen with momentum, right? Those big candlesticks have to come out, and that sets you up for a decent scalp trade, right? Now, for this reason, we typically go for options that are about one strike out the money, okay? Because we want that gamma to be a little of a build-up, one strike out, and that allows for delta to build up if it goes beyond one strike as well. Typically, we want to capture one strike of gamma and then start stacking delta after that. So the next thing you want to do is pick strikes that have adequate liquidity, options liquidity. And what does that mean? That means you can get in and out easily. And how do you know if you can get in and out easily? We are typically looking for OI to be more than 500, or open interest, right? And a volume of more than about 500. This is a good guideline, but you can't really always get a perfect amount of OI and volume. And the reason for this is because some option chains are just going to be worse than others. Like a stock like, for example, Lululemon, or a more like safer stock like maybe, I don't know, Johnson & Johnson or P&G. They might have just lower liquidity in the option chain. So as long as you see that for a specific expiry, you can find a higher open interest, go with that expiry. That would be a better choice rather than picking the expiries that are just the closest, or picking a specific strike and just sticking with that. You have to be a little flexible in choosing these strikes and expiries, right? So that's a very key thing to remember. This will facilitate the smooth entry and exit of positions in terms of liquidity, right? And for the expiration of the contract, right, we typically just go for the same week expiry, because it doesn't matter. The time value component here rarely matters. Okay, you're going to be in and out the trade so quickly that most of the time the expiry doesn't matter. However, if you are a beginner trader, like just started off, I recommend not trading scalps with the weekly expiries on Thursdays and Fridays. Okay, on these 2 days, you should avoid trading the weekly expiries. Now, I know that's counter to what I've put here, but this is a big caveat, because for people who are familiar with options trading, you will realize that with scalp trading, the volatility tends to be very high when you're trading same week expiry contracts. And therefore, on the Thursday and Friday, when the theta starts to accelerate and gamma starts to accelerate, those minutes can literally be a huge swing in your profit and loss. And that's more psychological than anything, because it's going to make you think that, oh my goodness, it's going up. Oh my goodness, it's going down. And that's going to cause you to either sell early, or, just make a bunch of mistakes that you really don't want to make, right? Either you sell early or you hold too long. So to avoid that, I would recommend Thursday, Friday, switch over to the next week expiry for a scalp trade if you are a beginner trader. If you know how to trade volatility, then the same week expiry, it makes sense. Because here's the thing, if you are a beginner trader, the chances are you haven't mastered the market psychology yet. And that's an important part that discerns beginner traders from intermediate or advanced traders. Because for us, when we are trading a weekly expiry on Thursday and Friday, we believe in our trading outcome. We trust what we see in the market, and we know that at some point of time, we will get to that outcome. So we're willing to hold it through the day, or if it's a scalp, then follow the rules of engagement with the scalp and cut the loss if it hits a specific point, right? So you have to be really, really careful to follow your rules of engagement. What is your trading plan? Follow it to the T, right? So since the nature of a scalp is to be in the trade for minutes at a time, we don't pay extreme attention to the expiry of the contract. Since your aim is to maximize the profits by taking advantage of momentum, weekly expiries will facilitate maximum gamma exposure. As I mentioned, gamma exposure will be the highest in a weekly expiry, right? So that's the things you have to be really aware. If you're a beginner trader, go easy on these. Maybe what you really want to do is paper trade and practice with the weekly options on the paper trading account before you actually start taking it on your live account. That's one of my biggest pieces of advice, okay? Now, what about for day trades, right? For day trades, we are assuming that the time frame is going to be from minutes to hours, right? So it's going to be an intraday trade, right? So for this reason, we still go one strike out the money, but we focus on the key pivot points here. What is the range break? What is the area where we are seeing significant supply and demand breaks? That's a key level. Okay, if it breaks that level with momentum, we can take the day trade, right? And we want to pick strikes that have adequate options liquidity once again, OI more than 500, volume more than 500 to facilitate the smooth entry and exit, right? But here, the expiry can differ. Even for an advanced trader like me, I will never trade the same week expiries for a day trade after Wednesday at 12 p.m. So for Monday, Tuesday, and Wednesday before 12 p.m., you can take the same week expiry. But after Wednesday 12 p.m. Eastern, you should trade the next week expiry, okay? Not the same week expiry. So Thursday and Friday, absolutely no, because what happens here? Traders start to price in theta decay, okay, after Wednesday. People always think that it happens over the weekend, but no, it actually starts getting priced in on Thursday and Friday. And so traders know that the weekend's approaching, they start pricing it in, they start getting rid of their contracts. So we want to be mindful of theta acceleration into the midweek to the end of the week as theta decays the most on Thursday and Friday. And so traders will typically sell saturated options contracts from high IV positions on Wednesday after the lunch while rolling exposure into the later time frames. What does rolling mean? It means they close out the existing trade and open up a new one with a longer expiry, okay? So they roll their trade forward into the next expiry. So this is what you have to be aware of. Now, with day trading, you can, of course, vary your strike. It doesn't always have to be one strike out the money, okay? Like, for example, the market is open right now, right? And we're seeing some considerable price action to the downside, right? And I know that, okay, you know, NVIDIA here is about to break this key level here, right? So this is obviously a live example here that I'm showing you, right? And so, okay, we are approaching a key level of the support, supply zone that was a previous supply zone. Now, what am I going to do with this zone? This zone is going to become a dual zone, right? I'm going to change it to white because now this has a potential for a bounce here. This previous level of supply might become demand, so I have to be extremely careful, right? So when I go into the 1 hour time frame, I'm going to be watching for a possible bounce at this level here. And I'll be watching very closely at around 193 all the way up into 194.50, which is this level here, right? If I do get the break below this level here, right, around this level here, let's just say 193, 194, right, roughly, then I might consider taking the trade to the downside, right? And so then if I want to take this to the downside, the nearest support is going to be this level right here, right? And that's going to be 186, right? So 194 to 186, that's quite a bit of a drop down. So we don't want to go that out the money, right? We want to go slightly closer. So maybe we'll take a strike that is nearer, right? So 193, maybe 190 would be sufficient, right? So we have to go to the option chain and see if we can actually get a contract that will serve us this purpose. So let's say I'm looking for a day trade, right? So I will go and I will look at NVIDIA right here, right? And this is obviously all live right now. So, okay, if I'm planning a day trade, today's Monday, so I will have a look at the option chain, right? And here I want to look for the put options because we want to trade it to the downside. And the level that we were looking at was going to be around 190, right? Okay, so let's have a look at the option chain. So 190 here has the best Open interest, you can see that. It's 8,000 and 11,000 volume, right? So a lot of traders are hitting this strike. So this might be the strike that you might want to take a position on if you really want to trade it, right? So that would be kind of an example, okay? So sometimes the one strike rule is not always like, oh, you know, we have to take it at the one strike. It varies, right? The conditions vary. If I see such a strong condition like this, then I might want to take it, right? Which also reminds me, what kind of a gap is this, right? Just to put things together a little bit here, you can see this is a exhaustion gap, right? If you remember it from the previous class, this is a exhaustion gap. So it does look like NVIDIA would want to break through this level and start heading downward after such a huge wave up, right? Remember, wave up, wave down, wave up, wave down, wave up, wave down, wave up, and now it's starting to reverse. So we need to see it form a wave down and then a wave up, a higher, lower high, and then a wave down, right? And then a wave up, right? So this would be wave one coming in, and obviously I'm on the 1 hour chart now, so we have to go into the 15-minute for that confirmation, right? The 2-wave confirmation. So on the 15-minute, we can see we are just in wave one right now, right? We can still bounce here. It's not confirmed that this is in a downtrend yet, right? How are we going to confirm it's in a downtrend? On the 15-minute, we'll wait for this to come down, then come back up, retest. And if I can see that it fails to retest this level and starts to break further down, then I will be taking a starter position somewhere here, right? And then on that second wave up again, the second rejection to the downside, this is where I will add to my position, and that will probably be the break of the key pivot here as well. So we'll get a confirmation that this is now in a downtrend, right? So that's obviously the plan for now, but how it plays out is a different thing altogether, right? Okay, great. So I just wanted to show you guys something during live market hours so that you have a good understanding of how things work. Now, what about for swing trades? Well, swing trades are a really interesting one, right? So with swing trades, there are just two things that you need to remember. The first thing is that for a swing trade, we suggest going somewhere between 30 days and 90 days. The ideal scenario is between 50 to 80. Okay, this is the ideal zone. Okay, but here's the thing: when you take 30 days, then you have the quickest acceleration in contract price. If you go 60 days, then you have slower acceleration in contract price. If you go 90 days, you have the slowest acceleration in contract price. The 90-day option will always have the highest delta, and the 30-day option will always have the lowest delta compared to all three periods, right? So how do you choose the right one? We typically will look for a swing trade that will be in between 50 to 80 days. Okay, that's a sweet spot. So 50 to 80 days. Okay? So on the option chain, we'll be looking for something that will say, you can see on the option chain, it actually gives you the number of days to expiry. So let's say we want to take an NVIDIA swing trade, right? Well, look here. You see these numbers here, 4, 11, 18, 25. That's the number of days to expiry. So that's an easy way to count the number of days. So maybe 50 to 80, we want either one of these. We want either the March or the April contract, right? Great. So now, how do we pick a strike? So for example, with NVIDIA, okay, let's say we want to plan a day trade on this, right? Sorry, not a day trade, a swing trade, right? So let's go and plan a swing trade. Now, we can only take the swing trade if we have confirmation that we're breaking below here, and then we can play that swing trade to the downside, right? So we need to break and close below around 191, this level here. This would be the pivot, right? This is the pivot right here, right? This is for a confirmation for a day trade. This is a confirmation for a swing trade, right? So if we can break below and then have that two-wave confirmation, and then NVIDIA wants to come back down, then we need to start picking strikes, right? So where are we likely to come down? Well, we could use a Fibonacci retracement tool for that if we know this is the end of the wave, okay? So we are gonna, just for a simplicity's sake, I'm gonna add a module about Fibonacci's in the future, but I wanted to just show you where the likely price level to come back to is. So usually on a wave, you will see a 50% retracement, which is around 173. So let's just say if it does break around 191, which is this level here, right? If we do break here after the two-wave confirmation and then start rejecting, right? Then we would want to see an extension down here into this level. So this is our target. Let's just say this is our target. And our target is at 173, okay? And our entry is going to be around, let's say, 191, right? Now, how do we pick the strike? Well, do you just go like 5 strikes out, 10 strikes out? Well, there's an easy way to answer this question. You pick a strike that's in the middle, okay? So how do we get the strike that's in the middle? It's literally here, right? Around 180, okay? So we pick the 180 strike. Why? Why do you pick the 180 strike? Because do you remember the chart of the relationship between delta and gamma? Gamma accelerates at the money, and then what takes over after that? Delta. So we want the peak acceleration, right? From here all the way to here will be the peak gamma acceleration, right? And then from after the peak gamma acceleration, we'll have delta acceleration. Delta acceleration. So we want to pick strikes that are in between because we will get the best of both worlds in a swing trade, okay? Now, for a person who has been swing trading for a very, very long time, I can tell you that this has worked out really nicely for me most of the time. As long as you are able to keep your psychology in check, you will do just fine. So once again, to reiterate, if you don't, obviously not looking at just NVIDIA chart, but just looking at a normal scenario. If you have a demand zone and a supply zone, you're trying to trade between $80 and $100. Remember, you have the two-wave confirmation, and then you have your entry here, right? And let's say your entry is at $80. And your target is $100, then your strike should be 90. Okay, so pick halfway the strike. All right, so you have your strike and you have your expiry. That's how you play the swing trade. Remember, you don't care about momentum in a swing trade. You only care about direction, and the direction is confirmed with the two-wave confirmation, which is EGA signature confirmation. Right, the two-wave confirmation gives you the confirmation that something is reversing out of its pattern, right? So that's the technical pattern that you need to know. And then the move up will first give you gamma acceleration, and then the balance move up will give you delta acceleration. So you'll get the best of both worlds, right? So that is how you're going to pick your strike and expiry for delta and gamma in terms of swing trades, okay? Now, for leaps, long expiry anticipation positions, we often use, so it's long-term equity anticipation securities. I thought it was long expiry anticipation positions. No, so it's long-term equity anticipation securities. I always get it wrong. As a type of investment option for a period of 1 to 3 years, right? As long as it's 9+ months, it's considered a leap, okay? These are also called share replacements. We spoke about this earlier, as it allows option traders to use less capital than you were if you're purchasing stock to deliver superior returns on capital invested, right? Imagine if I were to go and buy, let's say I was thinking NVIDIA was bullish, right? I have two options here. The first option is I would go and buy 100 shares of NVIDIA, right, at 195. It's currently trading at, right? However, the other way I can play this is go and look for a long-term contract, right? And now the market's open, so I can show you. That's why I'm recording this while the market is open, right? So if I want to pick a far out option, let's say I go 1 year out, right? 2023 January, 2024 January, right? Let's say 19 January, right? And I am thinking that, and so I want to buy it at the money, right? So let's say like where it is right now, right? 100 shares times 195 earlier, right? That's $19,500. That's what you would spend on the shares. But if you buy the leap at the money, look at that. You would only pay about $4,000, right? So you're getting a significant discount, right? You're paying less than a quarter, right? About a fifth, actually. So that's more superior, and you're holding the same exposure, right? The only thing is that it's susceptible to volatility, right? So that's the important thing about share replacement that you need to understand in terms for the leaps. But it's definitely a more cost-effective investment, right? That's what we call share replacement. So leaps can go very badly if you buy it on a stock that is speculative and has no solid fundamental financials. Okay, a lot of people mess up on leaps because they buy leaps on contracts for companies that they are thinking that is going to do really well. For example, they think, oh, hey, you know, there's this company called Lucid Motors and they're a competitor to Tesla, and I think it's going to do really well in the next 3 years. Yeah, and then the stock price plunged to like, I don't know what level, and then now it's again showing signs of recovery, right? But I'm just giving you an example of how people mess up, right? They speculate on things and then they buy poor quality companies, but they buy leaps on them. So you're bound to lose your money on that, right? Buying a leap on a leap contract on a stock will require premium, which will add to the existing stock price to form a break-even price of the share. So for example, when you are buying the NVIDIA leap, right? It was $195, and then you have the options contract, which is $40, right? So the break-even price of NVIDIA is $235. You need the stock price to go to $235 to break even on the debit that you spent on this contract. Remember that. That's what we call the intrinsic value of the options contract, right? Because you paid $4,000 for the contract, but then you need to add that value to the investment or the price per share because it represents 100 shares, right? So the stock price has to hit 235 by the time that you are anticipating for it to, in order for your trade to be really profitable. Okay. Now I'm not saying that obviously by expiry. I'm saying by expiry. So in a year from now, right? So don't get confused. It's not like you won't be profitable even if you hold it for 6 months and Nvidia goes up. Obviously you'll be profitable, but at expiry, it needs to be at least 235 because you have a break-even price that you have to get to, right? So example here is if the stock is $10, premium is $2, the break-even price is $12 for the leap to be profitable, right? Same thing with NVIDIA. Remember, at expiry, we're not talking about a hypothetical scenario between now and 1 month from now where NVIDIA goes up to $500 or something. Obviously, you're going to make stupid money on that, right? But we're just talking about break-even prices here because people often overlook that, right? Great. So leaps, really not a rocket science here. You pick something that's 9+ months out, right? And go at the money or go in the money if you want. Whatever you're comfortable with, because it's like buying shares. Go with a comfortable break-even price. That's what I would do, okay? So you can adjust that to however you want. If you wanted the break-even price to be perhaps like, higher, remember the premium will compensate for it. So let's say you take 130 strike, then you would have to pay $8,000 in premium, right? So that's gonna bring your break-even price to around 210, right? Example. So you gotta go with what you're comfortable with because everybody's risk tolerance is different. All right, great. So now I'm gonna jump into this next portion, which is setting stop losses for options. This is something that we covered in the previous module, but we covered it for just regular stop losses, right? And we were talking about options then, but now that you have learned options and you're familiar with it, you can understand another concept of how do you measure stop losses, okay? So there are two ways you measure stop losses with options. The first way is just called the arbitrary value, okay? This is where you pick a assignment based on the percentage. So you can go 20%, 30%, 40%. This is all based on your risk tolerance. Okay? Risk tolerance. A second way to do this is you can use the delta of the option. Okay? What does that mean? And this will work for everything except for the swing trade setup. Okay? So day trades and scalps, you can use this option. So let's say you have a risk-reward ratio plan trade. And let's assume that you think, okay, you're going to enter Tesla at 167, and you have your short trade set up here. Let's just say, I'm just going to draw a hypothetical scenario. It doesn't really matter if it plays out, but let's just draw one out, okay? Okay, so you have a 1:2 risk-reward ratio trade here, right? And I'm going to enter, let's say, short at 171, 170 or so, or yeah, and take the profit at around 150 for a short trade, right? So for this trade, maybe it's going to be, oh well, if it's a day trade, it's going to be smaller. So let's go for a smaller time frame here, actually, and then we can amend it a little bit. Okay, so let's say, yeah, okay, so this does look okay for a day trade, right? So we go risk off slightly above here. Remember, you don't want to put your stop loss you don't want to put your stop loss like right here. A lot of people make this mistake. They're like, oh, if it breaks this level, I'm going to get stopped out. Well, you're not leaving any buffer. You need to go like a little further above it. Because what can happen? A market maker can see your order and stop you out, right? So go a little higher, right? And then you can extend your take profit level to match up the risk to reward ratio, right? So then let the trade play out for longer, right? So you'll have to get a nice entry on this. Okay, so now let's just assume that you want to trade Tesla. Okay, so we're gonna go to Tesla's option chain. Okay, and obviously we're gonna say for a day trade or a swing trade, since it's Monday, we're gonna look at the option chain here. And what did we want as the strike price? Let me go like maybe around 1. So you have, let's say, an entry around here. We want to pick a couple strikes away. So maybe we go around here, which is a mini dual zone right here. So we have 162 as a potential strike, right? And we want our stop loss to be at around 185. How many dollars is that away? That is 11. Wait, is that, how much is it? This is, yeah, 1190. Is that 1190? 80, 82, 82, 83. Yeah, I think so. I think so. I think it's 1190. Yeah, 1190. So 11, in other words, what's another way to say what this stop loss is in a Greek language, right? This is from here to here is 1190 in dollars. But what does that equate to? That equals to 11.9 deltas. Why? Because every $1 move in the underlying represents $1, one move in the delta, 1 unit movement in delta, right? So 1190 in the dollar moves would be 11.9 delta roughly. We're doing a rough calculation, right? So let's just say 12, right? 12 deltas. So our stop loss, if we were to really use this risk to reward ratio plan, would be about 12 deltas, okay, for the option. And our take profit obviously would be all the way down here. So now let's say our strike that we're aiming for is around 162, right? And we're going to go for the weekly, right? Okay, so we have a 162.50. This is the contract, right? And what's the delta of it? It's 29. Okay, so what is, let's see here. Okay, so for in this case, obviously because the IVs are too high, it's not going to work. I didn't look at the implied volatility, but look at the implied volatility of the option chain. You can't use this as an example. So scratch what I just said. But essentially, what you want to be able to do here, because if you take 0.3 and you take it times 12, it's already going to give you the price of the option. But you can sometimes use the delta as a indicator as to where to set the option, at the stop loss, right? Am I calculating this right? It is right. Yeah, it's 73, 74, 75, 76. Yeah, it is correct. It is correct. So we can use it as a reliable indicator to set stop losses in some cases. I will try and find you a case right now since the market's open right now. So let's have a look at it together. So let's say Nvidia. Okay, let's just go look at Nvidia instead, because the Tesla one didn't really work out that well. Because it was, the implied volatility was way too high. Let's see if this is the same. 71%. Okay, let's see if it works out. Let's see if it works out. These are trial and errors that you have to calculate on your own. Like, you know, when you market hours, these are the things you have to be doing. It's not just, oh, I'm going to put my finger in the air and feel where the wind is blowing and, oh, this is the trade that I'm going to take. No, these are things you have to be calculating while the market is open, right? So, for example, on Nvidia, let's say we want to go for the 190 put. That sounds about right, right? Let's say if it breaks this pivot here, we can go for the 190 put, right? And this pivot is around 193, right? If we're going to take a short position here for a very, very short contract, quick profit contract, Oh, this is a long trade, sorry. We'll go for a short trade instead. Let's say entry around the break right here. And we take the 190 put. Let's say 190 is the take profit. We need to keep the stop loss pretty low. There we go. So a 2 delta stop loss, right? Because the stop is going to be about 2 and then the take profit's 4. So you have about a 1:2 risk to reward ratio, right? This is your risk, this is your reward, right? Based on this calculation here. Obviously, if it breaks the high of the day, then the trade is null, right? That's going to be like almost like a scalp trade, right? So 5-minute chart, you can see what I mean here. I'll zoom in so you can understand what I'm talking about. I'll drag this here. So you can kind of see this, right? If you have this kind of a setup here, it's a 1:2 risk to reward ratio trade if it breaks further and falls down, right? Okay, so you're risking 2 to make $4, right? So that's a 2 delta stop loss, and we are taking the 190 strike price for the weekly, right? So 190 and 2 deltas is about 60 cents. So in this case, it's going to come up to about 20 something percent, right? So 0.34, which is the delta, times 2 is 68 cents. 68 cents as a percentage of the current contract price, which is $3.45, let's say, is 20%, right? It's 20%. So you could calculate your stop loss that way as well. Okay, I'm just showing you the different ways you can calculate your stop loss. With the Tesla one, it didn't make sense because the IVs were too high. That means too many people are buying the contracts, so therefore the contracts are too expensive, right? With the NVIDIA trade, it's a little better, right? So that's another way of how you can calculate stop loss. However, I still think if you're a beginner trader, don't go with the crazy delta calculations. Just go and calculate your stop losses on an arbitrary value for the beginning, and then once you get more proficient, you can do the advanced calculations. Now, for a swing trade, the reason why it doesn't work majority of the time is because when you calculate the a stop loss for a long trade like this, especially with the long expiry, the delta is so high that it doesn't make sense. So the only way around that for a swing trade calculation using delta is to divide it by 2. You have to divide everything by 2, actually. You divide the risk by 2, you divide the delta by 2, you divide everything by 2. You're not messing up the risk to reward ratio of the entire trade. So let's say maybe this specific trade has a very high delta, then because you're picking an option that's like in between, right? So it's gonna have a pretty decent delta, and especially since it has time value, 50 to 80 days out, it's gonna have more delta. So what you have to do is you divide this by 2, you divide this by 2, right? And then you calculate your delta. That's how you would have to do it. You're not messing up the risk to reward ratio structure, but you are helping the delta calculation to be more reflective of the actual pricing. Okay. Now, more on this later, but for now, just understand that there are many ways to calculate stop losses. Delta is one of them. Okay. Great. So let's head into the last module of this part of the course. And of course, as usual, if you ever have questions, post them in the student Telegram chat. I will answer them, right? Sometimes you might be confused with what I just said. Ask the questions. I will repeat and I will answer. Even if I have to send a voice note, I will. Or if I have to re-record something, I will. I'll put a new module in if you guys don't understand, right? Your feedback is important. Of course, I want you guys to learn, grow with us. And feel free to ask any questions on even the Discord, anywhere that you want. So the last part of this class is going to be going through all the common mistakes that people make. Okay, what are the common mistakes? I'm going to talk about the delta versus gamma focus. That's a very big one. Unavailability of strikes. That's another one. The use of lottos or out the money options, and then stop loss misjudgments, which usually get people into a lot of trouble. This is going to be the last lesson that you'll take in this course, and obviously I'm going to add more to this. As I mentioned, I have plans to expand this module further, and I already have the next part of the curriculum plan, which will be added to this course for free at no cost, additional cost at all. Anything that I add to this course in the future, which is our flagship course, is going to be added to it in the future for free, right? So if you're signed up early and you took the benefit of like the early bird access, and or if you're alumni, you would have received an insane deal for this because it's lifetime access and you'll benefit from this for your entire life, right? And you have the one, if you took the 1 year Discord access with it, insane deal, right? So I'll see you in the next video here. We'll talk about all of these and then we'll wrap up the course.